Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update on what's happening in the Chinese economy. If you've been following the channel, you'll know that over the last few months, the Chinese economy has started to slow down dramatically. And this is causing major concern for the rest of the world because China is the second largest economy in the world and it buys in huge amounts of raw materials and also manufactures a lot of products that are bought by other companies that are then sold on. So if China is going into slowdown, that represents bad news not just for China, but also for everybody else. And the latest trade figures have now been released for August, which show that exports and imports are continuing to fall year on year for China. So this continues to represent bad news for an economy that is forecast to hit 5% growth in 2023. And as there are only now 4 months remaining in 2023, that's going to represent a major challenge for China. They're going to need to see a big turnaround in the last 4 months of the year. And the slowdown in the Chinese economy is having a detrimental impact on the currency, the Chinese Yuan, which has fallen by around 8% against the US dollar over the course of the last 7 months. And of course, one of the biggest factors in the slowdown in China has been what's been going on in the property sector. Over the course of the last 15 years or so, the property sector has really driven the Chinese economy. It equates to around 25 to 30% of total GDP. However, over the course of the last few years, there has been a serious slowdown. The government decided to put the brakes on the availability of debt to property developers, and that had a disastrous impact. And many of them are now defaulting and struggling to be able to pay the coupons on the huge bonds that they've issued. So in today's video, we'll have a detailed look at what happened to exports and imports in the month of August. We'll look at what's going on with the Chinese yuan. We'll have a look at the latest stimulus efforts that the Chinese government have introduced to try to get the property sector back up and running. We'll take a look at what's happening with diesel inventories because diesel is used by industry in China, so it gives us a good barometer of what's happening in the economy. Now, unfortunately for China, it doesn't just rain, it pours. Quite literally, they have been experiencing some serious typhoons over the summer period, and this has led to a huge increase in disaster relief costs, which is adding more pressure to the economy. So I'll have a look at what's been going on with that, and then we'll have a look at what the impact of the slowdown in China has had on the Japanese economy. Japan is now seriously concerned about its growth prospects as a result of the slowdown in China. And then finally today, I'll wrap up with my summary. So what I think is likely to happen in China over the course of the next 3 to 6 months, and what the impact of this is likely to be for the global economy. So before we get started on all of that, if you haven't subscribed yet, then please hit that subscriber button. I'm on a push to try to get to 1/3 subscribers, so if you could help, that would be great. If you fancy giving me a thumbs up at this point in the video, that would be great. But if you want to wait until later on to make your own assessment as to whether or not you think this video has been worthwhile, then please do that. And if you'd like to support the channel, please have a look below where you'll find links to my Patreon page, where you'll find more face-to-face videos like this and other insights on what's happening in the global economy, as well as buy me a coffee and YouTube super thanks and membership. This chart shows the percentage movement year on year in China's exports over the course of the last 12 months. And the scale on the right hand side of this chart ranges from positive 15% growth at the top to negative 15% growth at the bottom. And the overriding message coming out of this chart is that in 9 of the last 12 months, China has seen a year on year fall in its exports. And for a country that is based on exports, that is the main driver of the Chinese economy. This represents a disaster. And you can see that over the course of the last 11 months, there have only been 2 months with positive growth, being March and April. And the reason for that positive growth was predominantly the fact that China removed all of its COVID-19 restrictions at the end of 2022. Up until that point, it was still putting whole cities into lockdown if 1 or 2 cases of COVID-19 were discovered. However, the Chinese authorities realised that this was suppressing growth in their economy. They removed the restrictions, and everybody expected that China would be a roaring success for the rest of 2023. And we saw an initial bounce back in March and April. However, that bounce back was very short-lived. And as you can see, in May, exports fell by 7%. In June, they fell by more than 12%. In July, there was a fall of almost 15%. And in August, we've seen a fall of 8.8%. Now, if you're looking for a glimmer of hope in terms of what's happening, you could say that there's been an improvement in August compared to what was happening in July. But a year-on-year decline of almost 9% doesn't represent good business from China's point of view when it's trying to hit 5% positive growth. And as we discussed at the start of the video, there are now only 4 months remaining in 2023 for China to be able to turn this around. And if you have a look out of the window right now as to what's happening in the global economy, there aren't many countries who are doing particularly well. So that doesn't bode well for China. It isn't the case that China is having a particularly bad year and everybody else is doing really well. Everybody is struggling right now. And so in order for China to be able to turn this around and hit 5% growth, lots of really amazing things will need to happen over the course of the next 4 months. This chart shows the year-on-year movement in imports for China over the last 12 months. And the scale on the right-hand side of this chart goes from 5% positive at the top to 25% negative at the bottom. And once again, the overriding summary of this chart is that over the last year, China has seen a year-on-year fall in its imports. And in fact, there have only been 2 months out of the last 12 where there's been any signs of growth. And that positive growth was minimal, 0.2% in September 2022 and around 4% in February 2023. In every one of the other 10 months, we have seen year-on-year falls in imports. And in many of those months, it has been a significant fall. In January 2023, imports were down by more than 21%. And in May, June and July, imports fell by 5%, 7% and 12%. And the figures for August show that imports are down by 7.3%. Now, in the same vein as what we talked about for exports, there is a glimmer of hope for China here because the month-on-month figures have improved between July and August. However, the 7.3% fall in August once again represents a serious shortfall against a projected growth for 2023 of 5%. And of course, the reason that imports are so important is that China, despite the fact of it being a net exporter, has to buy in lots of raw materials and fuel to be able to feed its manufacturing machine. It doesn't have everything on hand to be able to make things itself. So when the level of imports is falling, that tells us that the purchasing managers are buying in less raw materials and fuel because they're not expecting a major ramp up in terms of their production. So the level of imports really gives us advance notice as to what's likely to happen to exports. So the fact that we're still seeing a fall in imports tells us that it's very unlikely that the exports are going to take off in the last 4 months of 2023. This chart shows the movement in the value of the Chinese yuan against the US dollar over the course of the last 12 months. And as I'm sure you'll be familiar by now, the standard practice when looking at exchange rates between two currencies is that you tend to quote the strongest currency first, the one that has the highest value. So in this situation, we're looking at the equivalent value of the Chinese yuan against $1 US. So the fact that the chart is actually going upwards represents a decline in value for the Chinese yuan. On the 1st of February 2023, $1 US was worth 6.7 Chinese yuan. Today it's trading for more than 7.3 yuan, which represents a fall in value of almost 9% over the course of the last 7 months. Now, as we've discussed previously, the generally accepted principle in economics is that there's a direct link between what's happening in your economy and the value of your currency. If your economy is doing well, then generally speaking, your currency will do well. If your economy is doing badly, it tends to have a negative impact on the value of your currency. And that's exactly what we're seeing here. The deterioration in value of the yuan is moving hand in hand with the deterioration in the Chinese economy. Now, in theory, when the value of your currency falls, it has the potential of actually improving the volume of your sales because it can mean a reduction in the international price of all of your products. So just to give you a quick example to make that easy to understand, if you think about a product that was costing China 7.3 Chinese yuan, including their profit, to make and market in the international markets, if the international price was being adjusted in line with what was happening with exchange rates, in February of this year, that product would have been selling for around $1.09 in the international markets. However, today it would be selling for $1. And usually when the price of something falls, you can sell more of it because it becomes cheaper, people can afford to buy more. So that's the theory surrounding how a fall in the value of your currency could actually improve your exports. However, the data that we've just seen for August tells us that that isn't happening for China. The value of its exports is down year on year and has been consistently throughout the whole of 2023. So the reduction in the value of the yuan isn't providing any major benefit to China, and actually it's causing problems because the raw materials and the fuel that China is having to buy in, all of the oil and gas and coal and everything else that it's buying to produce all of its goods, are now costing more because all of those products are being priced in other currencies, whether it be dollar or euro or anything else that you can think of. And as the value of the yuan falls, that means that proportionately those imports are becoming more expensive. So that could be a contributing factor as to why China is actually importing less, because things have got more expensive, and so therefore it may be reducing the amount that it's buying. But the overall summary of this chart is that the value of the yuan has been consistently falling over the course of the last 7 months, and it doesn't look like there's any end in sight. Until the Chinese authorities sort out what's happening in the economy, it's likely that we'll see a further weakening in the currency. Now, as I'm sure you'll be aware if you follow the channel, the Chinese property sector, which has been one of the main drivers of the Chinese economy over the course of the last 20 years, is currently experiencing severe problems. In the first 20 years of this century, there was a feeding frenzy in China. Chinese consumers wanted to buy property, and as a direct result, large property development companies grew up and they were building cities all over China, and the building boom was fueled by debt. However, unfortunately, the Chinese authorities decided that they wanted to put the brakes on the sector, and they reduced the amount of debt that was being made available to all of those developers, and that's thrown most of them into financial crisis. The highest profile of all of these companies was Evergrande, which has over $300 billion of debt. It is the most indebted company in the whole of the world, and it got itself into a situation whereby it was facing bankruptcy. In fact, it recently filed for US bankruptcy protection as part of its debt restructuring. However, we don't have time to go into that right now. That is a completely different story. But the reason that I wanted to mention it is that it gives you an understanding as to why the problems in the Chinese economy are so difficult to fix right now, because it's impossible for the Chinese authorities to reverse their decision and allow all of the property developers to access massive amounts of debt. But until they can access cash, those developers can't finish the millions of apartments that they are committed to building. And a lot of Chinese consumers have actually paid in advance for those apartments. So this is continuing to cause huge issues. And it's now been announced that 4 of China's major state banks will start to lower interest rates on existing mortgages for first-time home loans, reducing them to the levels in place when the home was originally purchased. Industrial and Commercial Bank of China, China Construction Bank Corp., Agricultural Bank of China and Bank of China all issued separate statements announcing their planned reductions. The reductions will come into effect on September the 25th, and it's expected that the average reduction for first home buyers' mortgage rates will be 50 basis points, which is half of 1%, and could save Chinese consumers over $27 billion. And this concession is really important because first-time home buyers account for around 90% of the total amount of outstanding mortgages. China's combined mortgage book totals over $5.3 trillion at the end of June and represented around 17% of all loans on Chinese banks' books. And whilst this obviously represents good news for Chinese consumers, it represents bad news for Chinese banks, as the mortgage rate cuts will put more pressure on their margins at a time when the government is expecting them to do more to support the economy. So basically, this will reduce their profit margins and therefore will have a further negative impact on what's happening in the economy, because China right now needs to make sure that companies have access to capital to be able to invest, to be able to grow. So if the banks start to reduce their loan books because they're not making enough profit and therefore don't have enough capital to give out, then that could result in further problems. This chart shows China's inventory of diesel and gasoline dating back to January 2022. And the reason I wanted to share this with you is that the use of diesel and the amount of stock that China is holding is intrinsically linked to what's happening in the economy, because diesel is predominantly used for industrial purposes in China. Now, the scale on the left-hand side of this chart is measured in millions of metric tons and goes from 13 million at the bottom to 18 million at the top. And the two lines that are shown, the darker red or purple line is diesel, and the lighter red or orange line is gasoline. And if we focus in on what's been happening to diesel stocks, you can see that in 2022 there was an increase in diesel stocks between January and March. However, in the period between March and November, there was a marked reduction in diesel stocks. And that reduction in diesel stock represented the fact that industry was using that diesel, so there was demand for diesel. However, if we look at what's been happening over the course of the last 12 months, you can see that between November and March 2023, there was a marked increase in diesel stocks. And diesel stocks have remained high ever since that period. And this really reflects the slowdown that we're seeing in the Chinese economy. The diesel was bought in advance of being needed. However, as industry hasn't been hitting the numbers that everybody expected it to, diesel hasn't been required. So once again, this is giving us advance warning that it's unlikely that we will see a major turnaround in the Chinese economy at any point in the near future. So just when you thought it couldn't get any worse for China, it turns out that the weather is going against them as well.
In some suburbs of Beijing, roads have become fast-flowing rivers. This was the scene on Sunday in Wuhan city after relentless rain since the weekend. This man stranded in his car in the gushing floodwaters was rescued by firefighters. Hundreds of roads have become flooded in the country's capital. Social media posts showed floating cars and road signs in Mentugu district being pulled along by fast-moving torrents. This is the remnants of Typhoon Doksuri dumped record rainfall on the city of nearly 22 million. This mountain road in Gansu province in northern China crumbled away as floodwater gushed against it. Emergency personnel created a rope bridge to evacuate 2 trapped workers. Another road in a village in Fangshan district collapsed amid the record rainfall. Hundreds of thousands of people were driven from their homes in the southern province of Fujian. Average rainfall in Beijing reached 7 inches between Saturday night and Monday afternoon. The maximum recorded rainfall at a weather station in Mentugu hit 23 inches, according to state media.
Over the course of the summer months, a number of typhoons have hit China, resulting in extreme rain, flooding, and major damage to infrastructure. And it's now been reported that China's direct economic losses from natural disasters in July and August have increased to $10.3 billion, which is nearly double the losses of the first 6 months of 2023. This summer has been unusually wet for China, and the north of the country, including Beijing, has been hardest hit by floods after the area saw record rainfall from Typhoon Doksuri. Around 9 million people nationwide were affected by natural disasters in August. A primary contributing factor is the relative lack of historical exposure of inland areas to typhoons, thus weakening their defence mechanisms. And the seriously bad news from China's point of view is that it's bracing itself for more powerful storms and rain in September. And parts of the country are expecting to see more than 50% higher rainfall over the course of the next few weeks. In the first week of September, 2 typhoons hit southern China and brought violent winds and dumped record rainfall that forced the evacuation of tens of thousands of people. And obviously from China's economic perspective, this is the last thing that it needs right now. Policymakers in Tokyo believe China's deepening economic woes could hit Japan's fragile recovery. In a sign of growing pessimism over China, the Japanese government said in its monthly economic report for August that concern over China's outlook was among risks to Japan's recovery. China is Japan's largest trading partner, accounting for 20% of its exports. China's downturn would leave Japan's export-reliant economy with little external support. Exports to China fell by 8.6% in the first half of 2023 as demand for cars, steel and electronics wilted. A downturn in China may diminish the chance of Japan achieving sustained wage growth, which is a crucial condition for phasing out monetary stimulus. Economists believe China's downturn could knock 1 to 2 percentage points off Japan's annual growth for 2023, fueling fears of a prolonged slowdown in Asia's 2 biggest economies, which combined account for around 1/5 of total global gross domestic product. And China's current weakness will make it difficult for Japan to achieve its target of 2% inflation for 2023 after 2 decades of deflation. So what's the summary and conclusion today? Well, I wanted to post this video really to give you an up-to-the-minute update on what's happening in China. And the latest data that we've seen in terms of trade tells us that there are still major problems going on right now. Exports in August were down 8.8% year on year. And for an economy that's looking to achieve 5% growth, that is a complete disaster. China's whole economy is based upon exports. It's the world's biggest manufacturer. It makes lots of things and sells them all across the globe. So when exports are down 8.8%, that represents a huge swing away from a 5% growth target. And that's one of the major concerns that is now starting to permeate all around the globe. Because as I mentioned right at the start of the video, China is the second largest economy in the world. So if it goes into a major slowdown, it's going to drag the global economy with it. And as we saw from the data on imports, they're also down 7.3% year on year. And the reason that the level of imports is important is that although China is a net exporter, it imports lots of raw materials, which it then moves through its manufacturing processes before exporting the finished goods. So if it's reducing the amount of things that it's buying in, that tells us that in terms of the lead time and what's going to be happening over the course of the next 3 to 6 months, it's likely that we will continue to see that slowdown because China won't have sufficient raw materials to be able to ramp up all of its manufacturing and therefore increase its exports. So the fact that both of these metrics are down year on year significantly is really bad news both for China and also for the global economy. And in terms of the other biggest sector in China, the property sector, which represents around 25 to 30% of the Chinese economy, we've still got major problems. Over the course of the last 20 years, there was a feeding frenzy in terms of new apartments. Property developers literally couldn't build them quick enough. People were queuing around the block, sleeping in the street the night before release to be able to get on the list to buy these properties. But unfortunately, because the debt facilities have been taken away from those property developers, they haven't been able to complete those builds. And that's left millions of people in China in a situation where they've paid huge deposits, in some cases 100% of the purchase price, so the full amount of the actual apartment cost up front. And they're sitting with huge mortgages for these apartments that haven't actually been built. They don't exist. So that is a major problem. This is unlike any property disaster that we've seen in the West. When there are problems in the property market in the West, it manifests itself as a fall in prices. The majority of the market in most countries around the world is in second-hand properties, properties that were built 20, 50, 100 years ago that are changing hands. But in China, things are very different. The vast majority of the market is new build. So the property developers are right at the forefront of what's happening. And the fact that they can't complete all of their builds and that people have paid in advance for them basically means that the whole market is completely torpedoed right now. And until those property developers are able to complete all of their outstanding work in progress, then the market is very unlikely to bounce back, despite the efforts of the Chinese authorities, who are introducing things like a reduction in first-time mortgage costs to be able to try and put more money back into consumers' pockets. But that doesn't give them confidence that the market is coming back. One of the reasons that the property market was so buoyant for a long period of time was that prices just kept going up and up and up. And so it was a no-risk gamble. Everybody wanted to get on board the runaway property train. But unfortunately, that train has completely derailed and nobody wants to get on board a train that's come off the tracks. And that's the situation we have right now. And until the Chinese authorities work out a way to be able to build back the confidence from the Chinese consumers, it's likely that the property market is going to remain in the doldrums, and that's going to continue dragging down the economy because of the fact that it's so important to China. Now, the data that we looked at earlier in terms of the reduction in the value of the Chinese yuan tells us that there are fundamental problems in the Chinese economy right now. If you've been following the channel, you'll know that there's an intrinsic link, usually, between the value of your currency and what's happening in your economy. If your economy is doing well, then generally speaking, there will be demand either to invest directly into your country or to buy your goods, and therefore that increases the demand for your currency and pushes up its value. However, when there are problems in your economy, there is generally a reduction for your goods, and so the demand for your currency drops. and the level of investment from overseas also falls. And that's exactly what's happening in China right now. And the problem from China's point of view is that it's reducing the purchasing power of the yuan in the international markets. And China is a big purchaser of lots of raw materials and fuel. If you've been following the channel, you'll know that China has increased its relationship with Russia significantly over the course of the last 18 months because it needs to buy in large quantities of oil and gas and coal to fuel all the growth in the economy. So when the Chinese yuan is falling, that is going to represent more problems for China, and it does become a vicious circle. It's very difficult to break away from what's happening. And so the Chinese authorities are trying to boost the economy because that's the fundamental driver that's linked to the value of the currency. But until the issues in the economy are sorted, it's likely that the Chinese yuan will continue to struggle in the international markets, and that's going to make things more difficult in terms of turning things around for the Chinese authorities. So the overall outlook from China's point of view is negative right now, and we're continuing to see data that tells us that the economy is not back on track. And the target growth rate of 5% for 2023 is seriously under threat. However, as we discussed right at the start of this video, China has a big impact on the global economy. So a slowdown in China is going to represent bad news for everybody else because lots of countries are selling things to China, and therefore if China is slowing down, that means that they will be selling less and therefore making less profit, less GDP. And also most countries in the world are buying huge amounts of things out of China. So if China is selling less, that means that everybody else is buying less. So the companies that would be importing things from China and then selling them to you and me are doing less trade. Therefore, those companies are making less profit, and that overall will result in lower GDP for each country. So the direct impact of the Chinese slowdown is going to hit all of us, unfortunately. It will obviously be hardest felt in China. That's where they'll be suffering the most. But it will, unfortunately, reduce the amount of things that China is buying from everybody else, and so slows down global growth. And as we saw in the data coming out of Japan, they're exporting around 20% of all of their products directly to China. So when China slows down, that has the direct impact on the Japanese economy, and so Japan is now likely to start to shrink. And in terms of the domino effect that we've talked about before, that means that any countries that are doing business with Japan will also see a reduction in their trade. If Japan is buying less, that means that other countries will be exporting less, and so their profits will go down. And so you can start to see the picture as to why a slowdown in China starts to have a knock-on impact throughout the whole rest of the world, because every other country will see a slowdown, and therefore it will buy less things from all the other countries, and it does become a vicious circle. So the overall summary of today's video is that China is continuing to struggle. There is a real risk that it won't hit its 5% growth target for 2023, and that means that the global economy is likely to slow down further over the course of the next 3 to 6 months. So I'll keep you posted on any further news and developments coming out of China. If you've liked what I've said today, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.